time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. I've got a question on Quarterhill. It's a company we've talked about here in the past. It says, does Quarterhill warrant an investment after selling its IP or patent troll division and focusing on the ITS segment? So what is Quarterhill? The symbol is QTRH on the TSX, trades at about $1.26, $145 million market cap. They operate in the ITS or Intelligent Transportation System market and have historically operated in the IP or intellectual property industry. This is a historically profitable area of the business, but it's lumpy. And this area was just sold. So the company is now a pure play intelligent transportation system business. And via its ETC and IRD subsidiaries provides tolling and commercial vehicle weighing solutions to government agencies. So the event here that is in the question is Quarterhill. They sold a 90% stake in their IP business, which was called Wyland, for gross proceeds of up to, and that's key, just up to $71.4 million. That's $48 million in cash, $8 million in an earnout, and $15 million in an unsecured promissory note. Both the earnout and the promissory note are subject to Wyland hitting revenue milestones. Let's look at the current fundamentals. Well, the last year includes significant Wyland revenues, particularly the Q1 of last year's, and it has poor margin performance from the ITS segment. Looking at the current numbers, produces kind of a muddy or kind of a terrible picture on the business, really. So Q1, we'll look at those really quickly. Revenues dropped to $44 million from $165 million in the comparative period. This was due to the size of the licensing agreements completed in Q1 2022. Consolidated adjusted EBITDA was a loss of $6.9 million compared to a gain of $79.1 million in the comparative period. That again, Q1 2022 saw a huge increase in IP revenues. There was a net loss of $15.6 million or 14 cents per share from a profit of 50 cents per share in the same period last year. Now, let's look at the balance sheet. Post this transaction, Quarterhill should have approximately $30 million in net cash, which is expected to be reserved for additional ITS M&A. Our take here, the important item to focus on near term is the 90% sale of the Intel IP business. Given what analysts and original management expectations were when the company originally contemplating selling its IP or Wyland business, they were looking for 100 to 200 million range. The deal is underwhelming. I just read a report which recently stated that the maximum gross proceeds were ahead of this brokerage firm's recently lowered valuations for Wyland. And I mean, their valuations a year ago were significantly higher. So saying they're ahead of your incredibly lowered results is not a win here. Even this rosy brokerage analysis pointed out that much of the consideration or part of the consideration is contingent on Wyland meeting revenue milestones, which creates uncertainty on the collectability. The sale, in theory, makes Quarterhill a more investable stock and provides additional dry powder to scale the ITS business, but recent ITS performance has not been good. The company's ETC division has had issues. They had 7 tolling implementations, which have placed a drag on margins due to revenue miss and cost overruns in most of these projects. As a result, the company is guiding towards this year just break even adjusted EBITDA. The above mentioned products are expected to enter a higher margin operational phase in the second half of this year, 2023, and the first half of 2024, where growth margins are expected to move from 10 to 15% right now to 30 to 40%. As a result, EBITDA margins should increase in the ITS segment from 6.7 to about 12.5 in that range. Now, this is good in theory. In practice, the results most often have not matched the theory historically at Quarterhill. For us, we have been commenting on this stock for almost a decade now, since the stock was in the $5 range. Quarterhill, for me, at present, is a broken company. The company has been through 3 to 4 management changes. The focus of the business has changed under different managing teams, with at least 3 different fundamental growth paths in completely differing businesses over that time. often with misaligned management teams and short-term outlooks. Once again, the company may have some cash on hand to start executing its consolidation within the ITS space, but this space has yet to produce real consistent cash flow. Even if we look at some of the most optimistic estimates for 2024, the company trades at about 7 to 8 times those numbers on an EV to EBITDA basis. It's not a premium, but the business does not deserve a premium due to the continually underperforming forecasts. So for us, this company is not investable at present.
Yeah, just take a pass on it.
Yeah,
awesome.
Definitely. I mean, I went through it there.
Nobody likes
laid
a
it
troll,
out.
right?
No. And I mean, they're getting out of that, and they could be. We interviewed management, which is not the current management, once again, about a couple of years ago. And we've done this several times because they've had a net cash balance sheet at times that looked attractive. The plan on paper has at times looked attractive. They just haven't been able to execute on implementing or acquiring a business in a segment like they're now trying to be in the intelligent transportation system business that has consistent cash flow. They just haven't been able to do that. The patent troll, the Wyland business, it produced solid cash flow over time, but very, very lumpy. You'd have these one-time wins. You could have a huge windfall payment from, say, an Apple, which would juice results in a current quarter. But the market never valued that highly. Many of these patent troll businesses that are dwindling off the market now, there was a time where they were more popular. But now, as the market has seen, you get such lumpy results on a quarterly basis. They just don't get, they're hard to value. They don't get the premium valuations. They usually get a discounted valuation. So I think it's a good decision to sell this. It's not a massive windfall of cash coming in. It's a decent cash amount that's coming in. But the existing business that they bought that they're trying to transition into is not very profitable. There's not a lot of cash flow there. So did you make a right decision even with this business? For us, it's a pass at this point.
Yeah. And just for anybody wondering what a patent troll is, so these are companies that essentially purchase bulk quantities, high volumes of technological patents. Mm-hmm. And then they find areas where, there can be a legal argument to be made that a company, maybe it's an Apple or a smaller company, a smaller tech company is violating that patent. It's not necessarily that the company is violating the patent, threat it. But just they can make a legal argument and then they can sue that company and, hopefully get some type of a negotiated settlement or else a ruling from the court. Now it's a highly litigious business. It doesn't really produce value, and it doesn't produce value at all. And as Ryan said, it's very lumpy. And when this first came out, when it first started to be a thing, I want to say like back in 2010, 2011, maybe.
Yeah, even pre like this.
Yeah, companies would just pay them off because it was cheaper to give them some money so they would go away as opposed to have to deal with a lawsuit and deal with all the legal fees. But then companies started to realize that this was just encouraging more of this. So they didn't.
Now there's strategies to just drag your heels in court.
Yeah, they were like, we need to send a message to the patent trolls that we're not going to just be, easy targets for these settlements. And that made the business more difficult. Anyways, it's not been a business that's gotten any type of a decent valuation from the markets in over decades.
And now this company recycling that some windfall cash flows into some other businesses has not been successful creating consistent cash flow in those businesses. So just a quick addendum to this. At one point, this business purchased a company that we had recommended at a significant premium. About 2 months after we recommended, it was like 50-60% higher. Again, we did the valuation on that. And at that point, we thought they paid too much for the business. We were happy to take the cash at that point because we, made a 60% roughly gain in 2 months. But the management's valuation, what they've used that cash, those windfall cash flows has not produced good, solid producing cash flow in the business at present. And, if they can do it going forward, maybe it's something we'll revisit. But again, they have an interim CEO right now. They need another CEO, a vision. Will that person be aligned? because they're, not immediately going to have shareholdings in the business. So they have to be aligned. We've seen, headhunted CEOs come into this business and they're not necessarily aligned with shareholders because they're driven maybe by a revenue number rather than a bottom line. So, I think it's broken right now until you can see some cash flow in the business. It's just a plan to get there, and they haven't got there yet. So until they do, it's something that we continue to stand on the sidelines and not invest in. And you've seen the share price just continue to get whittled away lower and lower and lower over time.